Alrighty.
How's it going, Joe?
Things are going as planned pretty smoothly, I'd say.
Good, happy to hear that.
And bring up the stream. Everything's good. Yeah. Let's see here. We got quite a few things to chat about here before the FOMC meeting actually comes out. Let's check out if the Fed is live yet. Russia breached global chemical weapons ban in Ukraine war, says the US State Department. That's pretty bad. Let's see here. Calendar. US Federal Reserve is poised to maintain its policy rate. Yeah, a lot of hawkish expectations here.
So that means the dollar's gonna be turned bullish if they do that?
Yeah, that's been the expectation for a long time here. But I have two outlooks that I was sent today that I want to go through. One from MUFG and one from Wells Fargo. So we had ISM manufacturing. So no relief for the Fed and ISM manufacturing. And as a thing to make it easy, let me go ahead and share my screen over here as well. So then it's easy for you to see. Yeah, there you go. Without the delay on YouTube. So let's see here, in addition to the pricing pressures from the services sector, Fed policymakers now have to reckon with the highest prices paid reading for manufacturing since the current tightening cycle was just getting started in September 2022. Yeah, that's pretty bad. It's above 60. So that's your goods inflation reaccelerating into the summer. It was myself and Danske Bank, I made a video going over the outlook of goods inflation potentially rebounding into the summer, and the only outlook that I could find that would use that as like the main theme was Danske Bank. And they gave like 2 or 3 pages on it. Let's see. Yeah, and then there were some other outlooks. They did cover it before, only like 2 or 3 paragraphs. So it's not really built into expectations yet. I have a feeling that over the next month, we're going to start to see a few more outlooks bring up goods inflation as a potential problem going to June, July. Let's see here. Not what the Fed wanted to see for prices. All right, so this is all historical stuff. Today's print for prices paid is a tough pill to swallow. It's consistent with the recent uptick in commodity prices and adds further evidence that the disinflationary trend from goods isn't going to be as much of a support factor in cooling inflation this year as it was last year. Yeah, 13 industries reported paying increased prices for raw materials, and only 1 reported a decrease. So that's pretty broad. Also, I think I saw here in Financial Juice, Let's see here. No, it was here. Yeah, uranium rises on U.S. import ban. Uranium prices were above $90 a pound, the highest in over 7 weeks, and holding the surge from late 2023 as tight near-term supply magnified speculative buying from physical trusts. And the U.S. Senate approved a bill to ban the import of nuclear fuel from Russia, the world's top producer. So if Biden signs the bill, Western converters and enrichers would fall under added capacity strains as trade restrictions and voluntary shuns of Russian fuel drive utilities to compete for long-term contracts. Okay. Yeah, in recent developments, the US and 20 other countries announced plans to triple their nuclear power by 2050. China leads the nuclear energy bet, currently holding 22 of 58 global reactors, while Japan restarted projects to build nuclear reactors. So that's nice to see. Uranium. We got a futures for it, right? Not that much data here on the futures, it seems. Maybe I need to go to a daily chart here. Nah, not there. You can see it's at, what, 89.95 there, which is the highest since, what, March 11th? So yeah, it's the highest in a while. Kind of at the top of a range here. But I should have in my commodities section here some uranium stuff. Yeah, these are a couple of uranium ETFs, and they don't seem to be moving a heck of a lot today. Looks like they gapped up, though, from way down here. So, 5% gap on URNM. And 4-ish% gap on URA. Yeah, so this isn't good on the inflation side, and this is probably going to keep the Fed higher for longer. This problem here with goods inflation. And I wanted to bring this up. This is all stuff on the yen, and they do mention here. Yeah. The price action in recent days highlight that it will be difficult for Japan to swim against the tide of fundamental drivers as they continue to send the dollar yen higher in the near term. Oh, we want to go here, dollar yen. And yeah, dollar yen has recovered like I expected after that dump that we had, and I did a little stream on it. I'm like, you know, if this thing doesn't continue falling like over the next 24 hours, this thing's going to go back to 158. And we got within a couple of pips of 158 here. Oh, yo, Harold, I see you in the chat. So I wanted to point out this little quip. It will keep pressure on Japan to intervene again if the pace of yen selling picks up again in the coming weeks and months. Oh, you're hot miking their TV. KTV, you're hot micing there a little bit. Might want to mute your mic. You there, KTV? No, seems like it's all good now. I'll let you know if it happens again. Don't worry. Let's see here. Oh, sorry about that, my man. Let's see here. Slowing inflation and stronger pace. So this is on Eurodollar stuff. And I wanted to bring this up because check this out. The stronger US dollar has helped to drag the Eurodollar exchange rate to a low overnight. as yield spreads between the Eurozone and US continue to move in favor of a stronger US dollar. Guys, yield spreads. Yield spreads mentioned. Come on, TradingView. Don't die on me here.
Joe, at another time, can you and I have a private where you show me or explain to me yield spreads? That's a concept that I'm still having trouble grasping.
Yeah, you know what? Most people, I go over yield spreads. Like, of all the indicators that I've made, people have the hardest time grasping what exactly the yield spreads are. And that's just because it's using data from bond yields from two different countries and comparing them. And then it's a matter of just like, okay, well, what did the numbers mean? At least at a minimum, you can see like, hey, red here means yields are moving in favor of the US dollar. So red is for the US dollar, and green over here would be in favor of the euro. So at least the bar colors simplify things a lot. But you really want to be looking at the big picture here. So these are all the yield spreads across all the different bond durations. And these values here in the little table just tell you what the actual value is between all these different lines. So this is a visual representation of these values over here. And the green and the red colors here should match the green and red colors over here in these hamburger bars. And then the net value from this, and as you see this picture change over time from one bar to the next, that gives us an insight into the direction of how yield spreads are moving and which currency is being supported by the yield spreads. I can go into more detail in it with you privately over a later time, not a problem. But that's just the gist, and that's for everyone who's watching on the stream, just so they know exactly what they're looking at here. This has been a known leading indicator of FX prices for 30, 40 years now. I mean, at almost every single outlook that I check out, yield spreads are constantly used by institutions and are constantly brought up in their outlooks. However, the one thing that kind of irks me in a lot of institutional outlooks is they only look at one of these yields. So they'll like only look at the 2-year, or they'll look at the 5-year or the 10-year. They look at the 2-year a lot because the 2-year has, it's kind of like the thing that leads things the most. It has the most significant correlation usually with price, but not always. So looking at the entire curve, you're able to see how expectations for the 10 and the 20 and the 30, the longer term yield expectations are changing, and then how the shorter term yield expectations are changing. And it's important to keep all those different durations in mind, because some economic events will impact shorter term durations more and longer term durations also more. Like, for example, the next Fed meeting that we're going to get is going to cover a lot of actually, let me do a quick double take here on, yep, FOMC is live here. So they're going to be starting in a hot minute. Let me turn this music off because they got some music playing here. Yeah, that's kind of some trippy music. Anyways, we'll let that go. Let's see here. Risk to inflation outlook are now balanced, says ECB to cause. Okay, so that's gonna make the ECB, that's gonna make this guy a little bit more dovish on the ECB side. Yeah, I lost track of what I was just talking about, actually. Let's see here. Are the risks of stagflation elevated? Pretty much, we expect government purchases will moderate in the coming quarters. Should our forecast come to fruition, our framework says the current bout of stagflation will end in the fourth quarter of this year. So they're still expecting some more stagflation. They're expecting things to still hurt on the real growth side of things, consumption to fall. Hey, Rod. Yeah, I am doing quite well. Been killing it on the trading side of things. Hoping that the FOMC comes out just hawkish. They actually say some hawkish things. Because I did point out to someone who asked me what my expectations for FOMC are. And maybe not exactly verbatim what I said, but the gist of what I said was, if the FOMC comes out not saying anything explicitly hawkish, and they come out definitively neutral on their forward guidance view, then that actually could be taken as somewhat dovish. And hear me out, because that's a relative view, right? The current consensus view is that the Fed's going to come out at least with a hawkish to neutral lean. So that's the consensus expectation, hawkish neutral. But if they come out just neutral, that'll be a shift from expectations from the consensus to in the more dovish direction, not by a whole lot. But it would send dollar to be a tad bit weaker in that scenario. So that's the primary risk that I'm looking out for in this FOMC meeting. But, you know, the likelihood of that is really, really small. Here, let's go ahead and check out the CME group stuff. Yep, 97% that they're going to stay flat here. Let's see here. September, when's the first rate cut expected currently? Yeah, it's not even 50-50 out into September. How about November? Okay, it starts to become 50. So November is when you start to get a 50-50 chance of the first rate cut. And December, it becomes the majority view. So right now, December is still the, you could say, where most of the pricing is for the first rate cut. Yeah, check this out. The improving cyclical outlook for the Eurozone economy is one reason why Eurodollar has proven more resilient this year, even as expectations for the ECB and Fed policy diverge have widened. This is why looking at growth is really important. So if the US sees more stagflation, right? If the US sees more stagflation, but European growth continues to grow, then the relative rates don't matter as much, and you can end up with negative yield spreads and increasing prices, serially increasing prices. Let's pull up the ranges. Actually, I want to pull up the probability pivots. That's what I want. So there's still a lot more downside potential here on the Eurodollar side of things. Looks like short term the yield spreads are actually improving. Yeah, check that out. Very short term here, going into the FOMC meeting, yield spreads are improving. So that's a bit of a positive outlook here. Risk on outlook. I wasn't expecting to see that going into FOMC. Let's see here. Yeah, but there's still some considerable downside risks there. Let's check the flip side of that. And yeah, most of the highs are around here. Unless we get that more, you could say, neutral turn, definitively neutral turn at today's FOMC. I wouldn't expect to, I mean, we could go to high 107s, 108s in that better scenario. Here, let's turn this down just a tad. How's the audio on your guys' front over there on the stream? And remember, if you want to hang out and ask some questions on the stream, go ahead and hop into the trading room on the Discord. All right, good to hear that the audio is all good. So let's see here. We got FOMC in about 9 minutes, so stick with me here, guys. Let's see here. Any other assets to check out? See how the ES is doing. Oh wow, not doing so hot here. I know Bitcoin also did not do so well today. Yeah, check that out. $10,000 dip over the last week. Minus 14%. I did have a bearish expectation going into this week net. Oh, didn't mean to move that. I was expecting the rotation somewhere around here, and well, we got the rotation right here. So, not as much upside as I was expecting and a whole lot more downside, but around the time I was expecting it on Bitcoin. Yeah. We still got 7 minutes to go, guys, until FOMC steps in here. So if you want me to go ahead and check out a chart, now would be like the perfect time to do it. I can also do this, which is the, the multi-layout view. So we got Bitcoin over there. Let's pull up the XY over here. And crude oil over there. Wow, crude is falling off a cliff there. Check that out in the bottom left. That's a minus 6% move. That's a $5 move. That is pretty bad. And we also had bearish expectations here on the S&P, and those played out just as well. We had less bullish expectations, so within margin of error, this was better. And we got the rotation timing correct, too. Oh, did the crude inventories come out terrible? Let's see here. Yeah, WTI falls to 1 month low. WTI crude oil sank to $80 per barrel in May, the lowest in over 1 month, as a rebound in U.S. crude stockpiles supported supply in hopes of a ceasefire in the Middle East trimmed the commodities risk premium. Oh, well, these are both generally good things that we want to see. Yeah. Wow. Holy smokes. So, we were expected to have 2.3 million barrels draw, and Inventories actually gained by 7.3 million, so that's huge. A near 5 million barrel build in inventory. Wow. That's a pretty big surprise. And it's one of the things that makes trading oil particularly hard, unless you're modeling how inventories are changing. It can be particularly difficult to not get swiped by these inventory swings. Yeah, thanks for that, Harold. Alright, let's go back to the big old screen here. Yeah, I found out that a lot of my drawings are not synced in all of my windows here. So if I go here, sync and layout, and now, here we go. Here's my other window on crude oil. Now all my drawings are over here. So that kind of sucks. Some of my drawings aren't around. Oh yeah. Let's head over to DXY real quick. Do the same thing. Little bit of housekeeping. And now here's my drawings over here on the right. Just hit save on that so I don't lose any progress. Yo, Ivan, nice to see you. Hello, Sumo. Suma? Summa? I think Summa's the right way to say it, right? Yeah, nice to see you guys hanging out. And remember, if you want to hang out with me here in the live chat, just hop into the Discord in the trading room. My Discord crashed. Oh no. Zuma. Zuma. Sounds like Zuma. Sorry, I'm butchering your name here, man. I'll get it one day. You could hop into the chat and tell me how to say it. Let's see here. How far are we away? We're about 3 minutes away from FOMC, guys. Again, if there's any charts you want me to check out. Oh, Ivan, yeah. As far as expectations go, I said it like 4 or 5 minutes ago, but I'll say it again real quick. The major risk that I'm looking out for is if the Fed explicitly comes out neutral, that is, they don't give any additional hawkishness. Because right now, the net current expectation is that there's going to be a more hawkish, neutral, leaning hawkish expectation out of FOMC, and specifically Powell's speech. That's where a lot of the focus for this meeting is going to be, not so much in the actual press release, but the statement from Powell. So if Powell doesn't come out and, sprinkle a little bit of hawkishness onto the actual rate decision today, it's going to be interpreted as just definitively neutral. And that's actually a major risk to potentially seeing some rebound risk on a weaker dollar. And that might seem counterintuitive, but when you're trading, consider that trading is about the change in expectations. So if the expectation is for a neutral hawkish view as the consensus, then going from neutral hawkish to neutral is going to give you diminishing returns on dollar longs. And I hope that makes sense. Yeah. The Treasury funding announcement, well, I don't think it's going to have that too big of an impact, to be frank. Yeah, I mean, I'm looking at the major risks to this event, and I'm starting off with that, and then going into, well, the consensus view is that Powell's going to come in and say something. Oh, this is an ad, so I'm just going to mute this. Turn back the music over on this side here. Yeah, I'm ad. This is all an ad. Hey, and I also got the little drawing thing. Ad. We don't like ads. No, thank you. No ads for you guys. We don't like ads. No, we don't. Yeah, you always want to figure out what the consensus is and how things can change positively in favor or against that consensus view. Trading, in my perspective, is about the change in expectations, not about the change in the thing itself. Relative changes are incredibly important. DXY falling. Oh, here, let me get rid of the drawings. Yeah, DXY falling. I bet you're right there. We can go to a 1 hour chart now here. But crude is falling, the S&P is holding up, Bitcoin is also holding up after got beat up so hard. Remember guys, these streams are on a delay, so please make sure that you're watching some of this stuff live on your end. I say if you want something super easy, check out Financial Juice. Oh, did we get some? Yeah, we got the rate decision out. Fed does not expect it will be appropriate to cut rates until it has gained greater confidence on moving sustainably towards 2% inflation. Actually, now would be a great time for me to turn on the squawk here. Traders see Fed cuts more likely in November now. What? U.S. short-term interest rate futures contracts rise after FOMC release here. Risks to achieving employment and inflation goals, quote, have moved toward better balance over the past year, as opposed to moving into better balance in the March policy statement. So, I don't know, it seems like grasping at straws at the moment.
Dropped after the FOMC statement, currently down 0.22% on the session.
Yep. Yeah, so the DXY fell a bit, but the S&P isn't rallying off this. It's not really interpreting this as risk on. Oil is going to be doing other stuff. Bitcoin
Oil
is
futures
improving
also
a little
extending losses. US crude prices down by $3 a barrel.
Hey, I'm ahead of the squawk chat. Let's see here. The press conference is going to be starting in about another 30 minutes here, guys. And in the meantime, they're literally going to be playing ads for 30 minutes for the FOMC. So I'm going to keep this on mute and check up on it periodically. Again, here's some risks. I mean, I don't...
So traders see a smaller chance of no Fed rate cut this year after the FOMC meeting.
I mean, yeah. Let's go ahead and actually check out the yield spreads. So let's go over to euro dollar and check out how the yield spreads are moving. Man, TradingView's a tad bit laggy here. So that's the 1 hour. We want to check it out on a daily. Well, these yield spreads are improving at the moment. Most of the negative yield spread is coming from the last 25 days or so. But over the last 7 days, to also comparing it from yesterday, yield spreads are improving. But then when you look at the nitty gritty of it, it's like, well, yeah, this is good. This is just bullish right now. This is risk on, in my opinion. But I'd still hold my horses here. Because again, my expectation wasn't that, like, hey, look, if we didn't have a Powell press conference coming up here in about 25 minutes, yeah, I might be wanting to flip long here, because given all this information here, sure, why not? Growth in Europe is accelerating faster. There's a better inflation picture there, sure. Rates and yield spreads might not be moving exactly in favor for the euro, but at least they're moving in the right direction. And that goes for, frankly, a lot of economies. However, if Powell comes out and says anything even, moderately hawkish, that's going to put the kibosh on this thing real quick. Yeah, actually, here we checked out the CME Fed Watch tool already, and they were already priced for November. Looks like they've now moved again a little bit more in favor. What really matters maybe is September, because this is effectively split 50-50. Look, there's even some guys 0.5% risk of another rate hike. Oh my god. If there were to be another rate hike, I'd probably expect it like in July, if goods inflation does reaccelerate during the summer, like what we're seeing here, right? ISM manufacturing. This is actually really bad here. Let me see if I can pull this up real quick one more time. Yeah. In addition to the pricing pressures for the services sector, Fed policymakers now have to reckon with the highest prices paid reading for manufacturing since the current tightening cycle was just getting started in September. So this is prices paid. So this is what manufacturers pay to get their goods. And this prices paid is going to lead to costs getting passed on to consumers. So this increase above 60 in prices paid is really, really horrible. And likely, it was like a month ago, it was essentially just me and like one outlook out of Danske Bank that was talking about the serious potential for reacceleration in inflation going into the summer. And now you're seeing more outlooks, and I think over the next month or so, we're going to be seeing considerably more outlooks identifying this risk of more US goods inflation coming in and, raining on the Fed's parade. Let's go ahead and turn this back on. Yeah, so far, again, the yield spreads are moving in favor of risk on, but you have a Powell speech coming up, guys. Like, it doesn't, like, unless it was a surprise cut, it wouldn't make sense for this thing to continue rallying higher. But if Powell throughout his entire speech just comes out again extraordinarily neutral for all intents and purposes, this release here was incredibly neutral, but that was what was expected. Now we have to wait and see what Powell's going to do, and if he's going to stay extraordinarily neutral. In that case, this move up might continue, but I doubt that, because now we have enough information here to be concerned about inflation continuing to reaccelerate into the summer. or at least stay even more sticky than previously anticipated. So and also, what was it, before the Fed blackout period, we had even more participants of the FOMC come out just explicitly hawkish. More people were turning more hawkish on the board. So I expect Powell to sprinkle some of his hawkish rhetoric over his speech when he comes out and gives it. Earlier today, I was one cut by end of year. Oh, it was one cut by end. Yeah. It still is probably one cut, one or two cuts, based on the outlooks that I've read. Yeah, two cuts seems to be the average still, as far as expectations go. But that's really teeter-tottering between like no cuts and going back to 4 cuts. Depending on who you read, which is why it's incredibly important to listen to a wide variety of commentators, not just on YouTube. Like, again, if you have a bank account, you can probably go to your bank and get outlooks from your bank. Like here from Wells Fargo, a lot of banks just hand this stuff out, and people would prefer sometimes just watching a guy on YouTube than reading these outlooks. At least I'm a guy on YouTube who brings up these outlooks, and I'm like, hey, these guys are saying yield spreads are important, so let's go over here and bring up the yield spreads indicator and see why they say that's important. Yeah, DXY following it. Yeah. So price doesn't seem to be holding up. We had a little bit of a spike here on that euro dollar. How is everything else moving? Oh, looks like the dollar's recovered a bit here. This is still a bit loud. Yeah, I'm going to turn that down just a tad more. Oil still falling, Bitcoin still holding. And the S&P is still going flat. So a whole lot of nothing. Everyone is just holding in the reins on their horses until FOMC actually comes out. It comes out in about 18 minutes, guys. We still got a lot of time to kill. So if you want me to check out a chart, tell me in the chat. Otherwise, I'll go ahead and, keep repeating the same things that I've been saying so far, which is, hey, we have inflation problems coming up into the summer. That's probably going to make the Fed more hawkish, on top of before the FOMC blackout period, we had more FOMC participants turn hawkish. So I think it's quite unlikely that when, Powell gives his press conference here, that he's neutral, right? But that's the main risk that we identified, is if Powell comes out explicitly neutral, doesn't give the press anything to work with on giving any sort of hawkish headline whatsoever, it would be interpreted as slightly dovish, but it'd be the wrong move right now, given the outlook that we have of higher inflation coming into the summer, and also stagflation risks that could go out into the end of the year. We suspect government purchases will moderate in coming quarters, which will dampen its contribution on real GDP growth. I know this is like technical macroeconomic stuff, but this is stuff that the Fed and markets pay attention to in order to determine kind of which direction things are going to go. You know what I'm saying? Should our forecast come to fruition, our framework says the current bout of stagflation will end in the 4th quarter of this year. So Wells Fargo actually expecting moderate stagflation. What was once a severe episode in 2022 has downgraded to a mild case in the open innings of 2024, current year. But the path of inflation remains uncertain. So again, this inflation part is a huge risk. We suspect the risk of stagflation remains elevated in the coming years, especially if the labor market does not loosen as presently anticipated. Yeah. Not great. And then here you can see like, hey, relative US to European growth, if you're looking at the euro dollar exchange rate, looks like European growth is doing slightly better. They're not in the same stagflationary setup as the US is. So if things continue to improve over the summer, there could be opportunities for probably some Eurodollar longs. That'd be nice to see. Oh, it looks like the S&P finally rising up. Yeah, so the DXY fell back. It popped on back. Dipped here on the release and came right on back. We got 15 minutes now till Powell's press conference here. S&P holding up here. Crude still falling off that insane inventories number. Instead of a 2.3 billion barrel draw of US inventories, we had a 5 million barrel build, which was an insane swing. And when supply increases in the crude oil market, yeah, you can expect this thing to continue falling. And now this thing has fallen really far past my expectations on the week. I mean, I was expecting the thing to fall, but I was also expecting the thing to bounce up into those inventories. But no, when you get an economic surprises change your expectations. But this is why it's important to do these sorts of things, like know what your expectations are going into the week ahead or into the trading day ahead. So then if new information comes to light or the move that you were expecting doesn't occur, that it gives you something to compare yourself against. Like, hey, I expected this move to occur and it didn't happen. Why was that? I don't know why. So then the onus is on you then to go and do the research and figure out, well, okay, why didn't this happen? Why didn't this happen? And just look at research for that day or over the next day. And you'll find someone who's like, hey, well, we moved like this because X, Y, and Z occurred. And you're like, oh, great. Well, the next time this happens, I need to remember to take into account X, Y, and Z as a potential risk to moving lower in my expectations. Like, whenever I set an expectation and I'm wrong on it, I don't mind having the wrong expectation there, because every single time I have a wrong expectation, I'm going to be learning something from it. And again, the XY is still holding up here. Bitcoin, it's kind of stopped its dump here so far, which is nice to see. Again, what a dump. What a dump on Bitcoin, man. Tell me, do you guys think that there's still that sort of risk of Powell coming out more neutral than not, now that I've talked about it? Actually, let's go ahead and real quick run a poll here. Let's just do it for DXY, right? Start a poll. Bullish or bearish? Go ahead, put in your votes now. Where do you think DXY is going to go post FOMC once Powell comes out and starts speaking? Do you think this could be the low for the day? Or do you think we're going to go down here into the tail? We can also check out the seasonal forecast indicator. Let that load for a sec. This thing up here into the left seasonal forecast. Wow, check that out. That is. It's slight positive expected value. The median return is positive up until like the 13th or 14th trading day of May, which is about the 20th calendar day of May. So if we were to follow just strictly the seasonal expectation, this is considerably bullish, especially from the 5th to the 13th trading day right around here. Yeah, this 9th trading day of May, what's that? The 13th of May on the calendar. Yeah, that is a particularly bullish trading. That's actually the most bullish trading day by expected value here for the month of May, it seems. Nice to get a whole overview of the month ahead like this, isn't it, huh? Let's see, trading spot. Initially, there were some good long orders loaded on the last lower wick. So, yeah. We think we the players. We the players. We the people. We the players. That's if a frat boy wrote the Constitution. Are going bullish on the first impression. Also, is the stream buffering at all? I'm hearing some guys telling me stream's buffering a little bit. Wow, 75% bullish so far out of 8 votes. And we only got 10 viewers in here, so I'm going to go ahead and end the poll and call it there. 75% bullish, wow. Peep outside USCL. Yeah, if you're not in CL. I wonder how the FX side of things have held up, because, you know, I got exposure to that. Oh, you know what probably really did get hit? Because look at oil right now. USD CAD probably got hit like a ton of bricks right now, right? No, not so much. It is improving a tad bit. The yield spreads are improving slightly, but those are really small improvements. Yeah, and it seems like it's reversing. You can see the numbers getting lower and lower. We're at 0.9, now we're at 0.8. So this is not moving in the right direction there. Yeah, and we got some good trades on for this USD CAD. At least I was able to snap some. We're just outside 138. Again, Powell's going to be speaking here in about 7 or 6 minutes, so stick around here. Powell's going to be coming up shortly. I don't need New Zealand strength anytime soon. Oh my god. I know so many guys who are just like, I can't believe I missed the New Zealand trade. Oh my god. Yeah, you know, it comes and it goes. This was my expectation for the month ahead, here on the 28th that I set. And this was my expectation for the week ahead. And I remember when I was doing this week ahead expectation, I'm like, dude, this is not gonna go well. And sometimes you have to commit to crazy expectations. And yeah, you know, sometimes you gotta commit to crazy expectations, and look how it plans, you know, sometimes it pans out really, really well. 100% bearish seasonality on New Zealand CAD until mid-May. Well, I mean market players, yeah. Oh yeah, you're looking at all the New Zealand crosses, aren't you, Ivan? New Zealand Swissy. Let's check out that New Zealand CAD first. I mean, it looks like the high is likely in for the week here. Looks pretty range bound probably for next week. I don't know, let's check out the low odds here. I'd say on the more bearish side into next week on this New Zealand CAD. Yeah, bearish on New Zealand CAD next week for sure. I wouldn't want to be long this into next week, that's for sure. And then what was that? New Zealand Swissy? Yeah. Oh, I actually set some expectations on this for the month ahead. Some up, down, and then up into the close again. Yeah, I would not be surprised if that was the low here. The yield spreads are turning negative on this, which makes me a bit cautious. Maybe it does a bit of a dump sometime next week. Maybe it reaches, what's that? 0.54 again next week. So probably more of a range bound with likelihoods of going past R1, S1. Just a tad past R1, S1. I don't know, let's check the upside odds. Yeah, it's pretty much range bound, but this seems like the skew is to the downside just a tad, so. Yeah, pretty range bound for next week here. Oh man, Powell can get here any closer. I'm counting down the minutes. 4 minutes or closer to 3 now. Verified wasn't loaded yet? Oh, well, that would be down to here. That'd be these low odds, right? And for pivots, range bound is... Oh, why am I doing this? I should be doing this over here. Range bound is between this R1 and S1. And based on these probabilities, you can clearly see we got a bit of a skew past this S1 pivot right here. So, you know, there's a little bit more downside risk compared to this upside view here that I'm seeing. Like, yeah, obviously there are some risks, right up here and a little bit right there, but it's not as significant as that downside, because here's your R1 and most of your highs, it's like 68% of your highs next week come in between these two pivots over the last 19 years of data we have, right, between R1 and central pivot. So I'd look for maybe an opportunity. Hopefully the thing goes down and then up and then down, right? Something along these lines, essentially. And then probably bounces into a close. We can go ahead and check out the close odds here. So this is how we do end of week planning. We look at our probability of closing between any two pivots, and yeah, it looks like that. We can also look at our ranges here. So instead of seasonal data, so I'd say probably a bit more of a stronger bounce at the end. And that, folks, is how you set a nominal expectation with range probabilities in the probability pivot points. I'm gonna link to this stuff's in the description. Comes with access to a trading group and one-on-ones and all that. And I'll timestamp this because I do like these expectations. So now we're in May, so I have to set this as my May 1st expectation. And yeah, this is what I do pretty much every week. Draw these lines based off the nominal expectation that I have. And now this is just based off the probabilities, right? If I were to do more research on the things that are different about New Zealand and the Swiss franc, I'd probably have more defined expectations. Like the other thing that I could do is go and check out the economic calendar, not for this week, but for next week, right? And notice that this is all next week's trading, right? I'm like, okay, whatever happens this week, it's okay. We got a lot of volatile events. Maybe it's not the best situation here. And we have Powell coming up right now, but yeah, I'm looking at the calendar for the week ahead to get better sets of expectations on top of these probabilities. And now we wait for Powell to come up here. And the screen's going to look a little weird for just a sec. There we go. And we're going to have all of our stuff here on the left.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that, that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, you know, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a re-acceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained, tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply-side distortions and demand-side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve?
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually, it's the time to get back there times the, times how far it is from the goal. And that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become, we're now focusing, the other goal, the employment goal, now comes back in to focus. And so we are focusing on it. And that's how we think about that.
Claire. Hi, Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, so you've got more supply, But those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. if we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy, sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8, now it's anyway, headline peaked at 7.1, now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation, and the reason why we're having this conversation, is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are there are a number of places in the economy where where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, you know, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without, significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but you know, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists, So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
Okay, that is it for the FOMC press conference for May. The next one is, I believe, going to be in June, where we're going to be getting some forecasts. And like I said at the very beginning of the stream, the primary risk for this FOMC was neutral expectations getting met. At the beginning of the stream, we had the press release. We had the initial rate decision come out. And that initial rate decision did come out neutral, flat. And we saw a nice risk-off move. That was really smart that we identified that risk going into ahead of the FOMC. Not a whole lot of commentators were looking at that, so I'm actually quite proud of identifying that risk. We had a poll earlier in the stream. I asked whether you guys thought DXY was going to go up or down, and it was 75%. 6 of the 8 people thought we were going to have a bullish DXY off the meeting. That was my expectation as well. But to you 2 people of the 8 who expected a bearish dollar, you know, hats off to you guys, because you nailed it. I'd love to read your commentary on why you had that expectation going into it. And while being bullish DXY was my expectation, being risk on a bearish dollar was something that I took into account for my risk. And so far, all my trades are sitting hunky-dory because I took that risk into account. When it comes down to how I interpret this press conference so far, I think he was pretty much flat out neutral. You can interpret this as a little hawkish or a little dovish, depending on which segment of the economy, which segment of the Fed's policy you're interpreting. So this is really going to be quite choppy. I really look forward to reading the outlooks that come out over the next 24 to 48 hours here on the interpretations from different institutions for this event. It'll be quite interesting. As far as my expectations going forward here, I do expect the dollar to recover. I don't think that this was enough of a significantly neutral change. Everything came in essentially at consensus, which was the more hawkish leaning aspect of things. So I expect the US dollar to make a full recovery from here and continue going higher into the first half of May here. Okay, with that all said, I'm going to say thank you all for watching. If you do want to hang out with me here in the Discord, you can go ahead and hop in now. I'm going to be here in the trading room for probably another hour or so. And if you guys got any more questions, feel free to ask them in there in the general chat, in any of the trading channels and any of the research channels. Some of the outlooks that are freely available, I'll be sharing the ones that are freely available. And thank you all so much for watching. I will see you guys in a bit.